Good afternoon, friends. Welcome to the webinar on Union Budget 2025. As you are all aware, India is touted as becoming the fastest large growing economy in the next two fiscal years. Similarly, it is touted as likely to become the third largest economy by the year 2030. However, in the short run, it seems to be facing some hiccups in that the GDP growth rate is between 6.3% to 6.8%. For the current fiscal year, it is expected to be 6.4% only. So it is definitely facing challenges, some headwinds. As a matter of fact, the world itself is facing economic headwinds. Eurozone is in trouble. China is facing a downturn, and so is Japan. So India seems to be facing a par for the course situation despite these hiccups. Of course, it remains a bright spot on the world economic scene. The factor which is of utmost importance in the present context is the Trump effect, which is likely to throw up a lot of imponderables for the world and for the US itself. Already, Canada and Mexico are facing higher tariffs, to which they have retaliated. Trump has not turned his attention to India as yet, though he has referred to BRICS as a bloc on more than one occasion. Therefore, a trade war seems to be looming. It is in the background of these turbulent times that the finance minister presented her eighth consecutive budget. She seems to have made the right moves. She has spoken of Viksit Bharat. She has focused on Garib, youth, Annadata, and Nari. She has identified four engines, namely agriculture, MSME sector, investment, be in people, be it in the economy in terms of capex, or be it in innovation in terms of research and development, and finally exports. She has presented several measures which should provide horsepower to these four engines identified by her. Needless to say, all these four engines are critical for the rapid growth of the Indian economy. Increased public-private partnership has also been highlighted in select sectors. Hopefully, all this would result in a multiplier effect, increasing employment and consumption. It is absolutely imperative that the GDP growth rate should rise to 8% or so per annum to enable India to reach Amrit Kal by 2047. Presently, oil prices are steady, or rather on the lower side, and for once, the Trump effect is positive when he announced drill, baby, drill. So oil prices remaining steady, a higher GDP growth in the medium term can be expected. The finance minister has referred to artificial intelligence. Needless to say, this is a double-edged weapon. It is an opportunity as well as a challenge, particularly for a country like India, which has a large number of deployable youth. Artificial intelligence should not render them jobless. This is the same type of challenge that one faced when one introduced computers. Typewriters were replaced by computers and there were large-scale agitations. Let us hope that artificial intelligence is used harmoniously with the rest of the needs of the economy. The economic survey speaks of upskilling the youth to meet the challenge of artificial intelligence. The economic survey, presented a day ahead of the union budget, speaks elaborately about deregulation, and the expression used is getting out of the way. It wants the regulator to get out of the way, suggesting in no uncertain terms that the regulator, generally being a regulator, gets in the way, acts as an hindrance, and slows the progress as a result thereof. The other interesting expression used is operating principle should be a person should be treated as innocent until proven guilty, as against the present position of guilty until proven innocent. All of us here would be happy to experience this in real terms if and when it is indeed implemented. For this, the states, the central government, and the bureaucrats which run the government have to imbibe this attitude in themselves. The finance minister has said that she would be introducing a new direct tax code this week. Unfortunately, no one knows what this direct tax code is. Since a complete overhaul of the Income Tax Act is sought to be introduced through this direct tax code, ideally it should have been put into public domain for the stakeholders to give their feedback on the same. Of course, she had sought suggestions from the stakeholders, but one does not know how many of them and in what form they have been accepted. Only when the code is presented as bill in the Lok Sabha would we would we know the implications thereof. Of course, it will take time to be legislated. It will go to the standing committee, and only thereafter, after the amendment suggested by the standing committee, that it would take the shape of an enactment. In view of this ensuing direct tax code, the finance minister has kept the direct tax proposals to the minimal. Of course, even then, with the relief being given to the middle class, the estimated loss of revenue on account of direct tax changes is about 1 lakh crores. The finance minister has also suggested several changes in the indirect tax regime, and unfortunately, not all of them are intended to make life easy for the taxpayer. One such amendment, which our team would be dealing with, is on the issue of input tax credit, where there is a proposal to have a retrospective amendment to undo the effect of a recent Supreme Court ruling. Retrospective amendments are always unhealthy. Whether these budget proposals of the finance minister will trump the headwinds is to be seen. Only time will tell. Of course, there are always naysayers who criticize any piece of legislation, be it the budget or any enactment. Let us hope that they are proved wrong. With these introductory words, I would now once again welcome you to the webinar. Our team will be providing an in-depth analysis of some of the important changes that are being introduced through the budget, both on the direct tax front and the indirect tax front. The team will answer questions at the end of the session. Let me now introduce you to the speakers for this afternoon. We have Abhay Upadhyay, who is a partner in the direct tax vertical, Kalpesh Unadkar, a director, a direct, a partner in the direct tax segment, Viksit Bhargav, a senior director in direct tax team, Ravi Omkar, a senior partner in the direct tax team, and Mr. R. Kumarvel, our senior director in the indirect tax vertical. Above, I would now request you to please set the ball rolling.
Thank you. Thank you, sir, for an insight on the macroeconomic aspect and geopolitical situation, the world that you just explained. In terms of amendments in the finance bill regarding transfer pricing and international tax and few other amendments in respect of IFSC, I would like to know start with amendments in transfer pricing slides. Yeah. So safe harbor provisions, as you are aware, that is in there in Indian code for quite a long time now. However, there has been not much of attraction of the taxpayers as far as this regulation is concerned. The reason are several. Okay, right now I'm not going into the depth of the reason as to what are the reasons, but uh, these rules have been updated frequently in terms of scope and also in terms of rates at one or two occasions. However, the finance minister has explained that she's going to enhance the scope of the safe harbor rules. Although, and rightly so, there can't be any amendment in the act because all those rules that you will see that is there income tax rules and not the act. So we can hope that there may be certain inclusion of other transactions to be covered under safe harbor provisions. And we also expect, although CA has not mentioned to that effect regarding the rationalization and reduction in the, but we can expect some rates to rise as well as in the safe harbor. What transaction that rule comes into light? Till then, we can only guess that there are many other transactions because it is not taking a proper shape in terms of its acceptance. So that's why it is in for enhancement of the scope of the safe harbor rule. Let's hope for the best that she introduces other transactions to be covered under safe harbor rules. Very interesting amendments in transfer pricing as far as the reducing the transfer pricing litigation is concerned. Block assessment in transfer pricing, as you're all aware, what is that in West and also in Europe and North Americas and few countries in Asia Pac. But the way block assessment in transfer pricing has been introduced in India through this budget, effective from 2026-27 assessment year, it is largely different from what we see in the West. In terms of the idea behind is that if you have a transaction in a specific financial year and similar transactions are getting repeated in next two consecutive financial year, then you have the option. Taxpayer has the option to opt for this block assessment. Now, in order to opt for block assessment, TP assessment, you need to file a form, and that form needs to be specified. It has not been specified so far. And also a rule will be also prescribed by the government, wherein details of the timeline within which the option has to be exercised will all be given. And all the modalities will also be explained in the rule itself. So what we understand currently is that the TP assessment in the block manner will happen like this, that suppose you have repeated transaction the transactions can be either SDT, a specified domestic transaction, or it can be international transaction as well. If you have repeated SDT or international transaction in the two consecutive financial year, excluding that current one. So basically the current one and the next the three financial year. Then you have the option to choose for the block TP assessment, wherein you request the TPO that please accept the transactions to be similar. Now, what is the meaning of similar? It has not been explained in the act also. So these are subjective things. Maybe, once the rules are prescribed in respect of implementation guidance are prescribed, maybe in that case, those things can be, explained. After the filing of application before the TPO for requesting him to allow or declare your request to be a valid request for the block TP assessment, transfer pricing officer will have to then or is obligated to issue an order, pass an order in this effect within a 1 month from the end of the month in which you have placed a request for block TP assessment. And then if the TPO considers your request to be valid, then the request will be processed further. Now, basically, No, the concept of this three financial year comes from the angle that when you file your Form 3CB for a specific year in the month of October, okay, and by the time the TP assessment happens for a specific assessment year, generally 2 to 3 years gets elapsed, and you already have no filed Form 3CB for next two financial year. So you are well aware of the international transaction that happens within these two financial years. So TPO, while passing the assessment order for the first year, he can very well apply the same principle and same methodology that he has applied for the first year to determine the arm's length price in respect of SDT and international transaction, and will replicate the same thing for the two financial year, consecutive financial year. So this way, of course, it is going to reduce a lot of duplicative effort, which transfer pricing officer generally deploys, and it is also going to reduce a lot of effort, compliance effort of the taxpayers in mitigating, and in also reducing the effort of in seeing that TP assessment is done smoothly. So this is a good attempt in terms of good idea concept. However, there are a lot of open points in respect of this. For example, when you apply for block TP assessments, what happens for the appellate procedure? Are you going to appeal to the CIT appeal or ITT altogether? There is nothing in the act so far as this part is concerned. Suppose, for example, in a specific financial year, you have got all the transactions which are similar in nature, but one specific transaction which is not similar in nature, and you are well aware, and you have already filed Form 3CB for that year. What is going to happen? Do you have the right and do you have the option to go in for this block assessment? Because block assessment talks about similar transactions. So you can always tell that I have similar transaction in two consecutive financial years, but there are few transactions which are not similar. Can I go for those similar transactions in the block assessment? Again, this is not very clear, because if you are allowed to go, then possibly the administrative convenience which is aimed for is not achieved that way. And there are other also issues in terms of its implementation. And considering this, they have also mentioned in the provision itself that if there are some implementational challenges in complying with the block TP assessment and meeting its conditions, then government can issue guidelines and clarify things. Next slide. No, there are amendment in terms of no meaning of significant economic presence. As you are aware that Section 9 deals with income deemed to accrue or arise in India. Okay, which also explains broadly the meaning of what is business connection, and the scope of business connection was expanded by Finance Act 2018 by introducing the concept of significant economic presence. Now, you are also aware that in Section 9 itself, there is a carve out for, or an exception, you can say, for not creating a business connection if the activity of non-resident in India is limited to purchase of goods for export purposes. So if the activity of non-resident is limited to only this activity, then business connection does not get attracted in India for the non-resident. Similar carve out was not there in respect of significant economic presence. So now the government has introduced that carve out for SAP also. However, no, there were certain expectations from the meaning of SAP, and that those expectations does not seem to have met. For example, the idea behind introducing the SAP was to deal with situation when foreign company or non-resident deals in Indian businesses without having physical presence, which generally happens through digital media. Okay, but if you look at the language of SAP, that still deals with physical goods, sale and purchase of goods. That issue still persists, and for that, in any way, we have to resort to the DTAA for going for a narrower meaning of a business connection, which is a counterpart permanent establishment. That issue has not been resolved by the government. So possibly government is possibly pushing for that, that even if you meet those conditions of 2 crore rupees for sale and purchases, and you do not have a treaty agreement with the foreign party, you will still have to go through the drills of SAP compliance, and you may still have to see whether you fall into the business connection in India or not. Next slide. Okay, another amendment has been introduced in respect of presumptive taxation. So scope of presumptive taxation has been expanded by way of introducing Section 44 BBD, wherein if a foreign company or a non-resident provides certain services or technology to any resident company, and that resident company is into the business of manufacturing electronic goods, for example, semiconductor or other things. Then in order to promote the manufacturing of electronic goods or including semiconductor in India, the government has tried to reduce or for ease of doing business has also introduced presumptive taxation for non-resident providing services to such unit which is into the manufacturing of electronic goods. Now, it simply states that the revenue realized by the non-residents, 25% of that revenue will be considered as the income of the non-resident, and then you apply that rate for competition. So effectively, the effective tax rate comes to around 5% for the non-resident. When we make payment for FTS and royalty for a non-resident, there is a withholding tax under Section 195, read with 115A, or the TT rate that we apply, which is effectively 20% as per the Income Tax Act rate, and 10%, 15%, 20% or the treaty rate, depending upon the treaty that you apply. Now, issue is that when you have already got a 9.5% rate for effective tax rate for under this presumptive taxation, still you have to follow the withholding tax rate of 10% at least, even if you apply treaty. Imagine, however, if you suppose you meet make available conditions and you do not withhold taxes because definition of FTS or FIS is not getting satisfied, in that case, the question is that you are not going to withhold taxes and the taxability will not happen. Again, the issue will be that does it mean that once you withhold tax at 10%, imagining that 10% withholding is applied after reading a treaty, and the effective tax rate for under 44 BBD is 9.5%. Does it require the refund by the non-resident when you file return of income in India? Because withholding tax has happened at a higher rate as compared to 44 BBD rate. So these are open points as far as this issue is concerned. Also, of course, as in other presumptive taxation provisions in India, a set of unabsorbed depreciation or brought forward losses are not to be adjusted. Another important difference with a few other presumptive taxation regime in India is that seems to be a compulsory section. There is no optional route that you have the option not to opt for it. If you are into this business and if you are rendering services, then that's a mandatory section. That is what the reading comes out. Next slide, please. Yeah. Now there have been significant amendments in IFSC, unit in IFSC, GIFT City. Now, basically, there is a Section 9A, which is in the Income Tax Act, which states that if there is an offshore fund and offshore funds, fund management activities is happening onshore in India, then there are certain conditions. If certain conditions are met by offshore fund and the onshore manager, then the foreign fund, the offshore fund, will not create business connection or POM in India, place of effective management in India. He will not be a resident in India if the foreign fund and manager in India meet certain conditions. This was brought in because generally the fund manager's activity in India was litigated in a sense that if you are performing fund management activity for a foreign fund, then the foreign fund used to be creating a business connection in India, or also foreign fund used to be considered as a resident in India under POEM. thing. Now, in order to mitigate that, 9A was introduced. However, in respect of IFSC, also there were certain other additional benefits was given a unit operating into IFSC. Now, I mean, as far as the amendment is concerned, is that the bill proposes now one of the condition in that if the Indian parties or Indian investor contributes more than 5% in the corpus of the foreign fund, then in that condition, if you exceeds that, then this relaxed provisions are not applicable to you. This relaxation are not applicable to you. Now, the question that arose was that when do you judge about whether the 5% threshold of participation in the foreign fund by the Indian investors exits? Because in a particular financial year, that percentage can increase or can decrease. So the reading was that even if you meet that condition of 5% in a specific point in time within a year, you are meeting that condition, and hence that benevolent provision of 9A would not apply to you. In order to mitigate this hardship, the amendment has been brought in wherein this condition has been relaxed in a sense that two dates have been given: 31st 1st April and 1st October, and you look at whether threshold is meeting on these two dates or not. If the thresholds are meeting in these two dates and you're exceeding this threshold, then you still have got 4 month time to correct that the shareholding, and you'll still be called to have satisfied 9A conditions, and you will not create a business connection in POEM India. So this is a very important amendments as far as IFS is concerned. Next slide, please. There are other IFSC amendments. I'm not going to dwell much upon that. Only thing is that most of the benefits in for the IFSC unit was getting sunset by 31st March 2025. This sunset clause has been extended to 31st March 2030, and there are a few other incentives which I think is very self-explanatory, which we can you know if I think so that is what the thing is for IFSC. Now I would like to request uh, Kalpesh to go for
The
other.
corporate tax amendments.
Thank
Thank
you.
you. Thank you, Abhay. We are going to talk about the taxation of the funds. So there have been a lot of changes which have been happening. Some of them could be because of the consequential amendment which were made in the Finance Bill number 2, 2024. So to give effect to them and to clarify some of the issues which are popping up, the finance minister has made some changes in terms of business trusts, AIF and FIIs. As far as the business trusts are concerned, we all know this is basically in respect of REITs and the InvITs. So REITs and InvITs were actually considered to be pass-through entities, and they have been provided a specific section to deal with it. It's section 11115UA. Now, as we know, basically what is happening is, in case of the business trust is concerned, these all business trust makes an investment into an SPV, which in turn makes investment into the shares or the debt securities, so wherein they will earn various types of income. It could be a dividend income or it could be an interest income. So as far as the InvIT is concerned and the REIT is concerned, when they get the dividend income and the interest income, they are considered to be passed through, and therefore the REIT and InvIT does not have to pay tax from the same. But yes, the unit holders who have made investments in these REITs, they would be liable to pay tax on the same. As far as the REIT goes, in addition to this, they will be, if they are earning any, if the REIT is earning any rental income, so then that is also considered to be a pass through. The question is, if there's any other income other than this three things which I was talking about, if the business trust is earning that income, currently the law provided that the income would be taxed at maximum marginal rate, that is an MMR rate, which is quite higher, except in respect of certain sections. Like, they had given that if there is a short-term capital gains which are covered under section 111A, and for that matter even some long-term capital gains which are covered under 112. But there were certain aspects in section 112A which currently override the powers of the section 112, and therefore these particular gains which are covered under 112A, that is basically arising on the listed equity shares or an equity oriented funds or itself a business trust, those were not getting captured and what was happening is, they were taxed at MMR. So therefore, to bring it everything in alignment, what has been proposed is that they have said that long-term capital gains which are arising from those which are referred in section 112A, that is equity shares, equity oriented funds, etc., now they'll be taxable at 12.5%, which is the rate which is generally which you see in other applicability also. There's another amendment which is proposed in respect of the taxation of the AIF. As we know, there are three types of AIF. Generally, we have seen it is that it's AIF 1, AIF 2, and AIF 3. As far as the AIF 1 is and AIF 2 is concerned, they are considered to be pass-through entities. As far as AIF 3 is concerned, it's not a pass-through entity and it is taxable at its trust level or AIF level. Now, when you talk about the AIF 1 and 2, which is there, so there were various incomes which are there. So it could the income could be in the form of a dividend or it could be in the form of an interest. The pass-through status was granted for this. So therefore, all the unit holders which were there, so the unit holders, when they were earning this income, that was considered to be a pass-through income. Coming to the other aspects which are there. Now, what has happened is there's a specific point which was there. There was a issue as to whether, when this AIFs are earning the income from the sale of the securities which they have. So whether that would be considered to be in the nature of business income, or it could be considered in the nature of capital gains. Now, as far as if it is in the nature of capital gains, of course, the pass-through status was available. But if the same is in the nature of the business income, the same it was taxable at the AIF level. So therefore, there is an amendment which has been proposed, wherein they are saying that if this AIF 1 and 2 have made an investment into the shares and securities, okay, these shares and securities would be considered to be a capital asset. Capital asset which is defined under section 2 bracket 14 of the Act. This is in line with the taxation which is presently provided for FIIs. So if you all recollect, in the past also there was used to be lot of fights in terms of FII also, because they were also trying to treat this as a stock in trade, and they used to say that they are not income earning from this gain in the nature of gains from sale of securities. They are in the nature of business income, not taxable because of no PE. So what is actually happening in this case is, if the same position is taken at the AIF level by various authorities, then that income would be taxed at AIF level. That means a pass-through status would not be granted to the unit holder. So there was a doubt as to whether what should it be? Should it be in the nature of capital gains or should it be in the nature of business income? To clarify that aspect, an amendment is proposed to say that any security which is held by AIF 1, AIF 2, they all will be considered to be a capital asset under section 214, and therefore a pass-through status will be granted and the unit holders would be liable to pay tax on the same. Coming to the third part of is the rationalization of taxations of FIIs are concerned. As you all recollect, in the earlier days before July 24, the FIIs were liable to pay tax at the rate of 10% in respect of the securities. It could be a listed securities, could be an unlisted securities. All the long-term capital gains always used to be the 10%. Then there is an amendment which came in the last finance number 224,000. What they said is that from July 23-24, if any securities which is there, if it is referred to in section 112 and all, then the rate would be 12.5%, which is there. But the main section which was there in 115 AD, there in one particular aspect, they have not mentioned other than 112A. Therefore, on account of which the tax rate used to continue with 10%. Although for all the other taxpayers, it had become 12.5% because of the last Finance Act. So therefore, to bring everything in parity, to rationalize the thing, they said now we are covering them that all these particular securities which are other than 112A, which is generally it's like unlisted securities would have been there, unlisted securities. Of course, there are some other things also which can get covered, but assuming those are there, other than which are not covered in 112A, the rate would be 12.5%. So now everything is in alignment. We go to the next slide. Carry forward of losses. This is one of the important amendment which has been proposed by the finance minister in the context of M&A transactions. Of course, in addition to this, the finance minister has also stated that there are many legislative changes which they are proposing in various other acts to hasten the place, so that all other things like approvals from the NCLT and all could be obtained very fast. But this particular amendment from will talk about only about the tax amendment which has been stated. As we all know, you know generally if I want to carry forward a business loss, there's a section 72 which talks about to say that I can carry forward the business losses for a period of 8 years from the end of the year in which the losses were first incurred. But there's a section 72A which was there, which was in specifically dealing with cases of amalgamation, business reorganization. When we talk about the amalgamation 72A, it basically more important was basically the company should be carrying on an industrial undertaking. It should be an industrial undertaking. Only in that situation you can get the business loss. Okay. So as far as the business reorganization is concerned, there are various business reorganization specification which have been stated, like if someone is converting a proprietorship firm to a company, or for that matter someone is converting a limited liability partnership or a thing to a company. In those particular instances, the losses which are there of the predecessor entity were also carried forward to the successor entity, but there was a fresh lease of life of 8 years which was provided. So any new thing, any amalgamation happens, so even if it is very already old 7 years, the fresh lease states means the first year becomes the year of amalgamation becomes the first year. So therefore I'm saying fresh lease of life which was given. Similar benefit was also provided in section 72AA, which used to talk about the banking companies and specified entities which are. So this was a provision which is currently prevailing. The department saw that uh, there are some people who are doing this evergreening of losses of predecessor entity, and because of that reason they have thought that and brought an amendment to propose an amendment to say that the benefit which is there, it will be capped for the period of 8 years from the end of the year in which the loss was first computed for original predecessor entity. So there is a restriction which now have been proposed. Of course, this amendment would be applied only for applicable for amalgamations and business reorganizations which are effected on or after April 1, 2025. It will not impact the already ones which have been completed. But what is important is evergreening of losses of predecessor entity, which is what the government thought. Now we have something very similar for the demerger provisions also, because even in the case of a demerger, one was getting only for a period of 8 years. So suppose for a minute I have already incurred a loss and I'm after 4 years I'm transferring my demerge undertaking to the resulting entity. So what you'll get is the resulting company will get only the balance 4 years, which is something very similar, which is now also proposed for amalgamations. When I talk about the losses, of course, unabsorbed depreciation of predecessor entity are not impacted. So that will be infinitely carried forward for the successor entity. Next slide, please. I think one or two issues which prima facie which came to our mind was, if you see what they have stated is that they've used the word affected. So what do you mean by affected? So they have said amalgamation, business reorganizations which are affected post April 1, 2025. So when you say about effective, what does it mean, an appointed date or does it mean an effective date? Because someone could very well say that effective is having also similar word with effective, so therefore it should be effective date which should be considered. So for a minute, let's say there's a lot of schemes which are already pending with the NCLT, and you get those approvals either before or after 31st of March 2025, but those have become effective only after subsequent conditions and all what have been prescribed have been completed. Will we say that now going forward you will not get anything, only you'll get it is for that period of 8 years? That's one question which is there. Or does it mean that although the approval is received post 31st of March 2025, but because if the appointed date is much earlier, I still continue getting those losses and that will be for a period of infinite years. For the period of 8 years means a fresh lease of life. So these are the points which are coming up for consideration. Debates are going on through, but I think the main important point which all we know is after their government is thinking of evergreen problems which is there. There's another issue which has come up is, what they have said is that you have to compute the period for the predecessor entity. Which predecessor entity? Original predecessor entity. Now original predecessor entity has been also defined in the finance bill. It says original predecessor entity means predecessor entity in respect of the first amalgamation under subsection 1 or first business reorganization under subsection 6 or 6A. So what was the need to put that first word? That's a question mark which is coming up. And someone could just try to think on it, like, what is it? Like, let's say you have a company A which merged into company B. Company A was having, let's say, 20 rupees as your losses. Company B then merged it into company C, let's say. So company B also had 30 rupees. And let's say company C, which is merging into company D, that is after April 25. Company C also had, let's say, 10 rupees. So totally, if you see, there are 60 rupees losses which are there, which are getting transferred in the next year. The question comes is, how will you read this? So that 20 rupees, if you say that first amalgamation means we are talking about company A, then you have to go and see whether that 8 years period are completed. If that 8 years are completed, then someone could say that, okay, then the 20 rupees has got lost. Then comes is the company B and company C. So then you may be able to only carry company B and company C, and that too for the balance period, if any, it's left. So if you see, there are a lot of things which are going to happen. There are a lot of complexities could occur. Like, say, if in between somewhere in one of the years I have got a gain, and that loss, gain or income has been set off against those losses. What happens to that? How will you set off against which entity? Losses. So these are some of the points which are there for consideration, which of course I think over the time we'll come to know about it. But I think for all practical purposes, government is possibly thinking that we will give only from the effective date and from the first amalgamation. So we, God bless all the people who are doing this internal reorganization and a lot of planning which is proposed to be taken the benefit for the 72. Then there are some other incentives which have been also provided. One of the incentive which has been provided is in terms of the benefit of tonnage tax scheme has also been extended to inland vessels. Inland vessels have been defined in under Inland Vessels 2021 Act. So if you are doing certain business with the help of inland vessels, they also will get the benefit of the tonnage tax scheme. As far as the incentive for startups are concerned, as we all know, they were enjoying the tax holiday for a period of 3 consecutive years within a period of 10 years from the date of incorporation. So this particular end date of the April 1, 2025, which was expiring it. So government has thought that we should extend that, and therefore, in order to give the benefit, the government has proposed to extend the tax holidays for startup incorporated before April 2030. I would now tell my colleague Vikshit to speak about the various aspects about the personal taxation and all. Thank you, everyone.
Thank you, Kalpesh. So I'll be talking about the slab rate changes, the most hot topic, I would say, in a budget which came up, and possibly this has made this budget look like a budget for a middle class. And thereafter, I'll be talking about certain personal taxation amendments and then TDS and TCS amendments which have been brought in. So what FM had said through this budget, this has been a liberal budget overall. And why liberal? Because I've not seen any draconian provisions brought in, nor any harsh provisions which have been brought in. Everything has been liberalized. Now, whether somebody would want benefits which were there, but they feel that the benefits are low, that would be a different thing. But overall, this has been a liberal budget. And in terms of slab rate changes, what the FM has done is they've increased the number of slabs. They've increased the size of the slab also. So they've introduced a special rate of 25% which is different from the previous rates. If you see the slabs 3 to 7 lakhs, it has increased to 8 lakhs. Then 10 goes to 12, 12 goes to 16 lakhs, 15 goes to 20 lakhs, and the trend is increasing. Therefore, there is benefits in every slab which is given. Now, let's see what are the benefits which have been given. If somebody was earning income of 7 lakhs, he has not earned any benefit out of this budget because he was non-taxable earlier also, but he is non-taxable now also. But what has changed is there is a benefit of a slab which has increased, and therefore the rebate has not been given on that taxable amount. If somebody was earning 10 lakh rupees, he's earning a total benefit of 50,000 rupees. 40 comes from a rebate, and slab rate change benefit comes from of 10K. If somebody was earning a 12 lakh rupees, his entire income is non-taxable. And what benefit he's achieving out of it? Earlier, he would have paid 80,000. Now, from a slab rate change, he's benefiting 20,000. And from a rate reduction, he's getting a rebate reduction, he is getting 60,000. So 1.1 note is that the person is taxable. It is only out of the rebates that he is not being taxable. So he is required to file a return of income to claim the rebates, etc. Now, the other thing which I would want to point out is that these rebates are only available to the new scheme. People who have followed the old scheme, the rates have not changed materially. They'll continue to get the rebate to the extent of 12.5 thousand rupees. One more aspect that needs attention. There was a judgment of Bombay High Court where the rebate was questioned, and what Bombay High Court had directed that what is being talked about is total income, which includes the special incomes also. Government has clarified that the special incomes would not be eligible for the benefit of the rebate. And therefore, if somebody was merely earning a specially taxed income, let's say capital gains or lotteries of 12 lakhs, they will not be entitled for any rebate as such. So in nutshell, seeing this budget, the benefit is so much that the new scheme has been made attractive, and the indication is that you should be phasing out the old scheme and coming under the new scheme. Now I'll be talking about the other amendments which have been brought in the taxation of income from house property. Earlier, 2 house properties have been claimed as exempt. I should not say exempt. The annual value of those properties were taken as nil. Therefore, there was no tax, but there were conditions attached to it. The first condition was there should be an occupation by the owner of that property, and the occupation which is there but could not have been occupied was based on the reasons for employment or business, because of which he was not able to occupy that property. Now, this justification, people used to find it difficult. So here also another liberalization has come through. The tax authority, the government now says is that you don't need to give a justification as to why you are not able to occupy the property. You can claim 2 properties as non-taxable. Now, I saw a few questions coming through on this aspect. One question was that a person had 3 properties. 2, he said that I'll claim it under this amended scheme. And possibly in the earlier days, he would have given the justification for it also. Now, for the 3rd property, his question was whether he could claim exemption because of he was not able to rent out that property despite taking those efforts. Now, this particular government has clarified that he would not be eligible for the exemption. However, there are a few jurisprudence which are there where they have said is that if your property is not marketable for any specific reason or facts and circumstances, then in that case, possibly a vacancy allowance could be claimed, because even after taking many efforts, that vacancy allowance under section 23(1)(c) could be allowed. So that is one aspect. The other possible question is, what is the meaning of occupation? Because the dispensation is only in respect of the second condition. The first condition is yet to be met. So occupation possibly means possession, So if a property is in your possession, it is under your occupation. Moving ahead. The other amendments, smaller amendments were, which are quite interesting also for the employees who are claiming NPS deduction. And if they want to provide for the children, NPS Vatsalya scheme has been pronounced a year ago, and contribution made into those schemes could be claimed as deduction to the extent of 50,000 rupees under section 80 CCT. Now, what the scheme provides is that if you're withdrawing the money, and that withdrawal is money is up to the 25% of the contribution, and those contributions of 25% is also accordance with the scheme, which is a permissible withdrawal, then that will not be taxable. Or if there is an unfortunate event that a minor is not surviving in this world, then in that case also, if there is a withdrawal, that would not be taxable. Otherwise, the withdrawals of the scheme would be taxable. There is an amendment of allowed to withdraw the contributions made into national savings scheme because no interest is being payable now. So they said that it would not be taxable since the time the interest is not being paid. And lastly, in this slide, the government has taken the authority and the power to make rules to define perquisites, which have been set many years ago, but the amounts have not changed. So in near future, we would be seeing that there would be changes in this amount. Of course, this needs to be tied off with the new regime because all these things may not be eligible, may not be seen as a deduction which will be available. So again, that needs to be seen whenever those amendments come through. The TDS and TCS provisions have come through. A significant liberalization has been provided. Then in this TDS, almost all the sections thresholds have been increased. Earlier, interest was tax deductible after 5,000 rupees. Now it is that limit has been raised to 10,000 rupees. Winning from lotteries were taxable on an aggregate basis of 10,000 rupees earlier, which has gone on the basis of 10,000 rupees per transaction. So if you have 10 transactions, they will not suffer TDS. Likewise, insurance commission brokerage thresholds have been increased. One more amendment of increase in threshold is of rent. It was said by the FM that 2.4 lakh rupees per annum threshold is being increased to 6 lakh rupees and no tax would be deductible up to that. But the catch here is that the payment has to be less than 50,000 rupees per month. If the payment is more than that, then taxation TDS will apply. And in a case also where, let's say, there is a revision of rent, and then during the year the amount increases from 45,000 to, let's say, 55,000, then only on the 55,000 when paid, it will be subjected to tax. Professional fees threshold rates have increased. Then another area where significant benefits have been given to senior citizens is earlier 50,000, beyond 50,000 TDS was applicable. Now that limit has increased to 1 lakh rupees. So these are the amendments which have been given under the TDS and TCS framework. There have been rate reductions. Rate reductions have been made when a payment is being made from a securitization trust to an individual. Earlier, it was 25% requirement to deduct tax. Now it is 10%. And likewise, if it was for other than individuals or HUF, it was 30%, which now is streamlined to 10%. TCS has been reduced in case of timber or any other forest produce from 2.5% to 2%. TCS on remittance under the LRS scheme for the purpose of education earlier was 0.5% with a threshold of 7 lakhs. Now that has been done away with. TDS on insurance commission has reduced from 5 to 2%. One more important amendment is there is no TCS on the education loan if that loan is taken from a specified financial institutions. There is no TCS on the specified goods, because the same would now be liable to tax under section 194Q. Now, there's an important aspect here. What transactions would be covered? Transactions with between non-residents and residents could be covered, and possibly where the non-resident does not have a permanent establishment and he is a buyer. In that case, TCS ought to have applied, but now, since TCS has been done away, the transaction would not be required to come under the tax net. A higher rate of TDS and TCS has been removed for the cases where returns were not filed by the deductees. TCS on LRS has been liberalized from 7 lakhs to 10 lakh rupees. So again, no TCS will be applicable for additional 3 lakh rupees. There's a substantial increase in the threshold limit of TDS, which I've already discussed on rents. And they've also decriminalized the TCS defaults, which is in line with the earlier TDS decriminalization, which happened in the last budget. The only aspect is that the tax should have been paid before filing of the quarterly TCS returns. Now I'll hand over the baton to our senior partner, R.D. Onkar, who will talk us through the charitable trust, updated returns, block assessments, penalties, etc. R.D., sir, up to you.
Thank you, Viksit. I will be briefly covering these budget proposals relating to charitable trust, proposals relating to updated return, proposals relating to block assessment in case of search and requisitions, and no liability for penalty in case of block assessment under search. So I'll just quickly run through the proposals which are relating to the charitable trusts and institutions. There are major three proposals. The first proposal is that in case of smaller trusts and institutions, the period of validity of registration has been increased from 5 years to 10 years, so that the trust will not be required to reapply every 5 years. For that purpose, the condition is that income of rupees 5 crores before exemption under section 11 or 12 for the past 2 years, preceding 2 years, would be considered for giving this relief. Second proposal is relating to the incomplete application for registration under section 12AB. Under the explanation to section 12AB, there are some specific violations, and under those violations, incomplete application for registration of a trust is considered as a specific violation, and trust was liable to suffer harsh consequences of deregistration. So the deregistration meant that the income of the trust will be taxed. It will lose its exemption just because some incomplete application was filed for registration. Now that harsh provision has been mitigated, and incomplete application would not be treated as a specific violation, and trust would get a chance to rectify that application and reapply. The third proposal, which is relating to trust, is the change in the definition of specified person. Specified person, as we are all aware, means a significant donor apart from the author, settlor, beneficiaries of the trust. There are also a category of substantial donor or his relative or a concern in which substantial donor has a substantial interest in that concern. So that definition was wide enough, and if it was found that some benefit has been passed on to the specified person, then trust was liable to lose its exemption status and it was liable for tax. Now, that definition of specified person has undergone a change. The relative of the substantial donor or concern have now been excluded from the definition of specified person. And the second amendment is that the contribution. Now, these specified substantial donor uh, to become a specified person, the condition was that if he has till the last date of the previous year has contributed 50,000 rupees, then he was liable to be considered a specified person. That was too small a limit, and that has been now increased to 1 lakh contribution, amount of rupees 1 lakh contribution in the previous year, and rupees 10 lakh cumulatively till the last date of the previous year. So these three amendments have been, brought in respect to taxability of charitable trusts and institutions. Now I will come to the updated return. As we are all aware that due to some misouts in the filing of original return, additional income used to be missed, and the assessee was given an option to offer that additional income in the last budget to file by filing a updated return within a span of 2 years. At present, the time limit was 24 months. Now that time limit has been increased to 4 years, that is 48 months, albeit with some cost attached to it, which is in case if the return is filed within 36 months, or rather in the third year, then the tax which is required to be paid would be 60% of the incremental tax liability, which will be related to the additional income, which is included in the updated return. And if the return is filed in the fourth year, that is in the 48 month period, then the tax would be additional tax, incremental tax would be 70% of the incremental tax liability. So tax liability here I am referring to is inclusive of tax as well as interest thereon. So total amount is, for 3 years it is 60%, and for 4 years it is 70% of the additional income which will be offered, and incremental tax liability will be attracted. Now there are some other conditions also, that the updated return can be filed only once. Return of loss cannot be filed as an updated return, and updated return cannot be filed where search has been initiated. Now, as far as the proposals are relating to block assessment, search and requisition cases, we are all aware that Finance Act number 2 of 2024 introduced Chapter 14B, and block assessment scheme was reintroduced in the Income Tax Act. Now, there are some amendments which have been brought in this budget, which are as follows. First is that the virtual digital asset, that is crypto, has been added in the definition of undisclosed income. Number two, multiple searches and assessments used to take place, and there was a confusion as regards the date of completion of the assessment and the initiation and completion of search. So in order to overcome that particular situation, amendment has been brought in, which is proposed, that in case of multiple searches, the previous search will have to be completed first before the assessment in respect of subsequent search is made. Then the third proposal is that the section 158BB provides methodology for computation of total income of block period. The computation of income under section 158BB has been clarified to provide appropriate treatment under normal provisions for income tax for income based on books of account maintained in normal course. So here the important proposal is this, that under this block assessment there will be computation of income which will include normal computation as well as undisclosed income declared in the return. So here it's a combination of these two incomes which will be considered under the block assessment. So reference to income declared by taxpayer in block return under section 158 BC1 has been provided as undisclosed income declared. So there will be undisclosed income declared, as well as there will be some income which will be computed under the normal provisions. And the combination of these two will be considered for the purpose of block assessment in the scheme in the block of 6 years. So that is how the total income would now comprise of undisclosed income determined by the AO under subsection 2, and various other income starting from the total income disclosed in the return furnished under section 158 BC. The time limit for completing the block assessment is proposed to be 12 months from the end of the quarter in which last of the authorization for search or requisition is executed. Here, the term used is authorizations. So here there is a amendment which is suggesting that in case of group cases, there are, again, there was some confusion regarding the authorization, the starting date, the end date, etc. And that is why, to overcome this confusion, it has been proposed that the last of the authorization for the search or requisition will be considered. And then thereafter, the assessment is to be completed within 12 months from the end of the quarter in which last authorization for search or requisition is executed. Lastly, section 158 BB3 has been simplified to exclude income relating to international transactions or specified domestic transactions out of the income of the block period. Lastly, regarding the penalty under section 271 AAB, it has been proposed that penal provisions of section 271 AAB are not applicable to proceedings conducted under section 158 BC, that is this block assessment relating to searches and requisitions. And it is proposed to amend section 271 AAB of the Act to clarify that its provision shall not be applicable to the assessee in whose case search has been initiated under section 132 of the Act on or after September 1st, 2024. Thank you. I request now Mr. Kumarvel to take us through indirect tax proposal.
Good evening, everyone. Though the finance minister did not speak anything about GST while presenting a wonderful speech, there has been quite a few significant changes brought about in the finance bill, actually. The first thing I would like to mention is about the abolition of the settlement commission. See, from 1st April 2025, the settlement commission would be abolished. I am referring to the Customs, Central Excise and Service Tax Settlement Commission. Now, to handle legacy issues or pending applications of settlement, an interim board has been formed or is likely to be formed once the bill is enacted. And the significant point here is there will be no judicial member. So the interim board will function as a, as an executive authority rather than a quasi-judicial authority. Okay, and I mean, those who wish to take advantage of settlements in excise, customs, and service tax by withdrawing pending appeals, they will have to hurry now because the end date is 31st March 2025. Okay. Then coming to reduction in customs, or rather rationalization of customs tariff rates, it is significant that 15 tariff rates are being reduced to only 8. So correspondingly, the number of rates read with respect to exemption notifications and concessional rate notifications would be reduced. 8 rates will include 0 rate also, is what the finance minister specifically mentioned. But correspondingly, to retain the revenue which is at current levels of revenue, around 32 commodities will attract cess. And she has also specified that only one cess or surcharge will be applicable, not more. Next. The feature of enabling voluntary revision of bill of entry or shipping bill is definitely going to be a very useful facility, in the sense that it is going to be enabled online also. Everyone would recall that if one has to change one's assessment, self-assessment, one has to first file an appeal or seek amendment under Section 149 of the Customs Act based on documents already on record. Now, in this case of 149, one had to completely rely on the officer concerned, and unless the reassessment is done or the bill of entry is amended by them, it will not be possible for you to get the benefit of lower rates or any errors that crept in inadvertently while filing the original bill of entry. Now, it is specifically mandated that even this revised bill of entry or shipping bill has to be self-assessed. So the onus or the burden of responsibility cast on the taxpayer or the importer increases significantly. And it has also been facilitated that the revised shipping bill or the bill of entry itself, the revised bill of entry, would act as a application for refund. Now, another significant relief or burden that is reduced for importers is time limit fixed in the act itself for finalization of provisional assessments. Now, till recently, you would have noticed that only in the provisional assessment finalization regulations, there were time limits fixed, but that too, only for matters like, documents have not been made available at the time of filing the bill of entry, or, test report has to be, furnished by the lab concerned, the customs lab, and such, minor matters. Whereas matters like pending cases of a similar nature, that is call book cases, if I may call them, they were one of the biggest dampeners or delayers of finalization of self-assessment. In addition to that, see, self-assessment also involves reassessment of the original bill of entry. So there was considerable administrative delay in that. In fact, years together, the authorities never used to finalize. In the case of Capro specialities, Bombay High Court had reprimanded several times, and in one of the cases fixed a time limit of 4 months. Okay, the exceptions again created in the amended section itself might still not give one the comfort that is promised under this amendment. Reason being, the same reasons for which provisional assessment finalization has been delayed now may continue in a different form. But one has to wait and see. Next slide, please. End use consumption. See, the time limit for end use compliance, that is after importation under the special provisions of import under concessional rate of duty for specified end users, was only 6 months. That has been extended to 1 year. And the other small facilitation that has been given is frequency of filing returns or statements, that is end use statements, has been made quarterly now instead of monthly. This may ease the compliance burden, is what everybody feels prima facie. At the same time, if you look at circular number 25 of 2024, recently, which came in November 2024, it talks about the glitches in the online utility, and the department has promised Excel utilities, which are to be now going forward from February onwards mandatorily used. Now coming to GST changes, I will, I've highlighted only some of the key ones. See, input service distributor definition has been amended or is proposed to be amended specifically to say that interstate IGST paid under RCM is also one of the taxes that can be distributed. ITC claimed on interstate supplies paid under RCM can be distributed. They have enabled this distribution of IGST, that is interstate taxes, even by amending the procedural provision, which is section 20. Now the question is, does this amendment mean that in past cases you should not have distributed ISD of IGST? Highly debatable and highly controversial. Requires a separate session to deal with this. Another new feature, track and trace mechanism, I understand is being introduced for sensitive goods. When we say sensitive goods, in the eyes of the department, they are all goods which are prone to being misused or where there is rampant tax evasion possibilities. I will not specifically name any of them. I leave it to your imagination. At the same time, I should say that something similar is already being adopted by the state excise authorities for curbing liquor smuggling. If you see on the net, you will find Chandigarh government has explicitly enabled this. Now here, this tracking of goods through, holograms and labels has to be through some technological device. Without proper technology backing, this cannot be done. Okay. So this may be for very limited number of commodities. Now vouchers, we all know in the last GST Council meeting, it was accepted finally that they are only akin to actionable claims. They are not supplies of goods or services per se. Therefore, the connected provisions relating to time of supply, which were artificial in nature, both for vouchers which can be exchanged for goods and vouchers which can be exchanged for services, both of them have been omitted now from the statute. Okay. Then blocked ITC is one of the hotly and very controversial aspect of allowing ITC for construction of a mall or other business premises. This has gone up to the Supreme Court and was extensively argued before the Supreme Court by both the petitioner as well as the department. In fact, the last leg was when the department was in appeal before the Supreme Court against the Orissa High Court judgment, which held that the block credit provision has to be read down, given the fact that GST is being paid on the lease rentals of the mall. Now, in the current budget, a retrospective amendment has been proposed saying that there was a drafting error, or on the grounds that there was a drafting error, the expression plant and machinery was what was intended in section 17.5C also. If you closely read the two sections, 17.5C and 17.5D, 17.5C says other than plant and machinery. 17.5C says that. 17.5D says, within brackets, other than plant or machinery. The Supreme Court distinguished between these two and said the definition of plant and machinery available in the explanation cannot be used to interpret plant or machinery. And in the judgment of Supreme Court, you will find that When the functionality test is satisfied, relief in the form of ITC has to be given, was the dictum of the Supreme Court. All that is labor lost now. Now, what about interest for past cases? When the amendment itself is retrospective, first of all, limitation will apply. That is a settled proposition of law. Second thing is interest, in my view, cannot be applied. They can only insist on reversal of credit. Reason being, interest is something that is triggered when there is a failure to pay. When the amendment is retrospective, it is like creating a new offense or a new statutory default. In such a case, it is not appropriate, and there are several case laws to say that interest should not be paid or should not be demanded. Now, does this mean the entire saga of Supreme Court judgment and cat and mouse game between the government and the courts and the taxpayers mean that ITC on this front is completely lost? This is a serious question to be pondered. It may be possible perhaps to arrange one's affairs in such a way and structure in such a way that it may still be possible to salvage the ITC through certain legitimate arrangements. This again requires a different session altogether to elaborate. Another important aspect is effect of credit notes. See, currently section 34 has one definite condition to say when the benefit of reduction in output tax liability will not be allowed to a supplier when he issues a credit note to the customer. Currently existing proviso only says if the burden of GST has already been passed on to any person, then if you issue a credit note, then no deduction will be allowed. Now that has now been replaced by a new proviso inserting two conditions, two mutually exclusive conditions. One says if the ITC proportionate to the value of the credit note is not reversed, no deduction will be allowed to the supplier. The second condition, which was existing earlier, has been retained, saying that if the burden of GST has been passed on, then also the question of reversal of the question of deduction based on a credit note will not arise. Obviously, what is meant here is only GST credit notes and not commercial credit notes. But then there can be litigation on whether this will extend to commercial credit notes too. Even though you will not get the benefit of reduction, whether you will get you will end up reversing the proportionate ITC. Anyway, that's food for thought again. Now, section 38 and 39 have been amended very specifically aimed at making IMS, that is invoice management system, to become mandatory from a prospective date, probably April. And everyone by now, I'm sure, is aware of what is the IMS facility and how it will restrict credits for you, or how it can be used by the government to restrict credits in certain situations. A pre-deposit for appeals against orders which levy only penalty. That has been now introduced in the case of orders under sections other than 129.3, and for orders under 129.3, earlier itself there was a pre-deposit of 25%. Now, if you want to appeal against such orders, which basically come from interception of cargo in transit due to way-bill related non-compliances, for that also now all kinds of orders without any tax liability but only penalty requires a pre-deposit of 10% for the first appeal and an additional 10% in the case of appeals to the CESTAT, GSTAT, that is the tribunal. Okay. Now, amendment in Schedule 3, another important amendment. See, already the existing section, the schedule contains an entry or para 8, which says that 8A very clearly says that transactions of supply within customs or within warehouses, within, or rather it uses the expression transaction in warehouse goods or supply of warehouse goods. Now, unfortunately, in the schedule, if you keenly notice, the expression warehouse goods was defined only with reference to the same provision in the Customs Act. The definition of warehouse goods in the Customs Act obviously does not cover warehouses which are established in SEZs and in FTW, Free Trade Warehousing Zones. Even though administrative control in SEZ and FTW is with the customs authorities, the Customs Act does not specifically include these two warehouses. Therefore, there was considerable litigation. Advance rulings are also there which are adverse, and therefore retrospective amendment is proposed. Unfortunately, in this case, if you see the last clause in the finance bill, it specifically says that no refund will be provided, and the reference to section 128 there is section 128 of the Finance Act that is going to be enacted. The clause 129, 128 of the finance bill refers to this amendment relating to Schedule 3, Entry 8. And the next clause very specifically says no refunds. So, Vikshit, can we now go on to questions?
Yes, sir. So we have received a couple of questions. Sir, I have to come back to you.
Okay.
There are two questions for you. Are there any major changes regarding GST in auto industry? And a similar question is, what is the budget impact on steel industry?
See, on auto industry, there are no specific changes in GST rates or anything, which you all know will come through only after recommendations from the GST Council, after evaluation by the rates committee. Okay. Now, as far as auto industry is concerned, there is an indirect benefit that is coming by way of amendments in the customs front. See, as you would have noticed, electronic vehicles require batteries, that is lithium ion cells. For manufacture of these cells, when imported capital goods, already exemption is available on 22 capital goods, and this list of exemptions is being expanded. So that will also benefit the manufacturers of e-vehicles. Other than that, I did not find anything specific as far as auto industry is concerned. Maybe for import of scrap indirectly again in the supply chain, you may benefit by getting lower rates of, or rather lower cost reduction in the foundry when you import scrap, metal scrap. And on that front, again, customs has given some relief. Okay. Now, as far as steel industry is concerned, same thing. There is no direct benefit accruing prima facie, but indirectly, when you import scrap for steel, lead scrap, zinc scrap, and even foundry scrap, there is a possibility of some indirect benefits of cost reduction. Any other question?
Thank you, sir. So another question which I have received is, limit under section 24 will be 2 lakhs or 4 lakhs, as a self-occupied property will be 2. So I'll take this question. I've dealt with the income from house property. The amendments which have been brought in is in respect of 23 section. They have not amended 24. So the limit which was earlier 2 lakh rupees will continue to apply. Interest deduction can be claimed in respect of 2 lakh rupees for a self-occupied property. It should not be 4 lakh rupees. Other questions which is there is, can carry forward of capital losses be covered by amendment of amalgamation? Kalpesh, would you want to take this?
Yeah. So yeah, so I'll take this question. So as we discussed, we were talking about the 72A, and specifically, they've used the word unabsorbed losses, and unabsorbed losses has been also defined in the section 72A, which says that losses would be of income from business and profession. So basically, in short, it will be a business losses, whereas when you're talking about a capital loss, that gets covered under section 74 of the Act. So in the case of amalgamation, you will find it not possible to claim the same by the successor entity.
Thank you, sir. Thank you, sir. So one more question I'll take. The question is, in case of block assessment, is this being adopted from any foreign jurisdiction? And if yes, what are the differences? Abhay, you want to take this?
Yeah, sure. So basically, block assessment as a concept is very popular in many, developed countries as far as transfer pricing assessment is concerned. So whether it is adopted or not adopted, I may not be able to answer that. But yes, as far as difference is concerned, the difference are many. One of the differences that I can see very easily from the face of the provision itself is that if you look at the foreign jurisdictions block assessment, they do not distinguish between similar transaction and dissimilar transaction. They cover all the transactions for a specific year and then other 2 years. Then whatever transaction comes, whether they are similar or not similar vis-a-vis the other year's transaction, they do not distinguish between these two. Other differences that you can make a note of is that you do not have an option. Okay, here you have an option to opt for block assessment or not. There they do not have an option to go for block assessment or not. You necessarily will be put up for a scrutiny for 3 years. Okay, I mean, so it is similar to assessment what we know every time face in routine assessment year wise. It's 1 year is a 3 year is a 1 year. 1 unit is basically 3 year is 1 unit. That is how assessment takes place in Europe and Americas as far as block assessment is concerned, which is different from what they are proposing to include in India TP legislation.
Thank you, Abhay. So those were the questions which came through. Anybody would like to have any further questions? We're happy to answer. We can wait for 1 or 2 more minutes. We can take 1 or 2 questions. I guess since we don't have questions, may I request just a minute? There's one question.
There is one question. Just a minute, huh? There's one question. So Sardul Kulkarni asked the question: would block assessment make advance? Yeah, would block assessment make advance pricing agreement redundant? I don't think that it will make the advanced pricing redundant. Advanced pricing will continue. If you look at advanced pricing is essentially no, it avoids litigation for future years. Okay. What will happen in case of block assessment is that the transactions have been taking place. You have already got the transactions on in the books, and how the transactions have taken place. So there is a difference in the concept as far as block assessment is concerned. Advanced pricing, of course, an element of 1 or 2 is there, but to say that advanced pricing will go redundant, I don't think that is the idea. Issue in advanced pricing is the delay. I would say. And that is why, these days there are a lot of pendency in advanced pricing. So it will not go redundant, but yes, block assessment will fill in, a couple of spaces, but of course, it will not go redundant.
Abhay, I think we have already crossed our time frame. May I request HP Majani sir to give a concluding remark?
Yeah. Thank you, panelists, for lucidly explaining the provisions of the union budget. Thank you, all of you, for joining. You must have seen that some of the provisions which have been proposed already have seeds of controversy sown in them. So this is bound to lead to litigation unless the government clarifies the position or brings in amendments after the bill has been examined by the standing committee. The direct tax code is due for presentation in this budget. That again may require analysis and presentation. Let us hope how it looks, and let us pray that it does not unsettle settled principles and jurisdiction. So thank you once again, all of you, for joining in. Thank you.